Morning. Good morning and welcome to my session on the YouTube channel of Unacademy. Before that, I would like to welcome you to Unacademy, India's largest online learning platform that gives you a world of courses, resources, content, live and recorded sessions to help you in your preparation for the CA Foundation and intermediate examinations. I would also like to welcome you to crack CA exams with us, which is a vertical and channel of Unacademy that caters to the students of CA Foundation and Intermediate in their journey and pursuit of preparation for the CA Foundation and Intermediate examinations by providing top educators, quality content, and overall a great learning experience. So come, let's crack CA exams with Unacademy, India's largest online learning platform. Welcome to my session once again. Just give me a second. Alright, also before we proceed, a brief introduction about the Educator today. Hello, I'm Prathik Gupta. I'm a Bachelor of Commerce from Christ College, Bangalore University. I am an Associate Member of the Institute of Chartered Accountants of India, an Associate Member of the Institute of Cost Accountants of India, and an Associate Member of the Institute of Company Secretaries of India, and also a law graduate from Karnataka State Law University. I'm currently a practicing chartered accountant and also a visiting faculty for CA subjects and an educator for CA students, both offline and online. Prior to starting on my own, I worked with S.R. Bartley Boy and Associates, that is the Indian member firm of Ernst & Young Global, in the Audit and Assurance Department. Then I went on to work with Ernst & Young India in the Mergers and Acquisitions Department. And then finally, I went on to work with the Manipal Group in Bangalore as the corporate controller of their Indian entity as well as their German subsidiary located in Frankfurt, Germany. It was only after I got back from Frankfurt, Germany that I decided to start something on my own, and that also gave me an opportunity to become an educator. Alright, so which in turn has given me this opportunity today, which will to take this session for you young, bright and enthusiastic CA aspirants. Thank you so much for giving me this opportunity, and I hope you find the session useful. Anytime during the session, in case you have any questions, queries, observations or discussions, please feel free to ask me, and I shall be happy to either take up the matter for problem solving or for discussion purposes, as the case may be, as soon as possible. Alright, also I would like to bring to your attention my name and the spelling of my name. My name is Prathik Gupta and it is spelled as Prathikgupta. It's Prathik with an H. Now, why I'm stressing on the spelling of my name is because a lot of people miss the H in my name, because of which they are unable to find my many sessions on the YouTube channel of Unacademy, and also my many special classes on the Unacademy learning app. So you can look me up with my name, that is Prathik Gupta. You can look me up to find my many sessions on the YouTube channel of Unacademy, as well as my many special classes on the Unacademy learning app. Alright, and after going through them, if you have any questions or queries, you can always get back to me. Now, like I told you, Unacademy caters to you in your preparation for the CA Foundation and Intermediate examination. It does so through three platforms. Now, what are those three platforms? The three platforms are YouTube, Special Class, as well as the Plus platform. Now, YouTube and Special Classes are absolutely free of cost, but they provide you a tremendous amount of value and resources to help you in your preparation for the CA Foundation and Intermediate examinations. YouTube is what you're watching right now, where you just need to go onto the YouTube channel of Unacademy, type in my name Prathik Gupta, and you will see all the many sessions that I have taken there for the benefit of the CA Foundation and Intermediate students. Similarly, special classes are also absolutely free of cost, and they are available on an app known as the Unacademy Learning App, more about which I will tell you further. But they are free of cost, but they provide you a tremendous amount of resources to help you in your preparation for the CA Foundation and Intermediate examinations. Coming to the Plus platform of Unacademy, the Plus platform of Unacademy is the premium platform of Unacademy, that is a payment-based subscription model and which provides various subscription packages for the various examinations. More about those packages in the following slide, but in this slide I will quickly tell you why I recommend and encourage you to become part of the Plus platform of Unacademy. The first reason why I recommend and encourage you to become part of the Plus platform of Unacademy is because of the daily live classes where you get to chat with your educator, engage in discussions, ask your doubts, and answer polls. All this while the class is going on. The second reason why I recommend and encourage you to become part of the Plus platform of Unacademy is because of the live tests and quizzes it conducts on a regular and periodic basis, which help in evaluation of your preparation and also get a detailed analysis of your performance. The third reason why I recommend and encourage you to become part of the Plus platform of Unacademy is because of the structured courses, where all the courses are structured in line with the exam syllabus to help you best prepare for it. And lastly and most importantly, the reason why I recommend and encourage you to become part of the Plus platform of Unacademy is because of the unlimited access it provides, where the one subscription to the Plus platform of Unacademy gets you access to all our live and recorded courses to watch from the comfort of any of your devices. So keeping all these advantages in mind, among many others, I strongly recommend and encourage you to become part of the Plus platform of Unacademy as soon as possible, so that you can enhance and accelerate your preparation for the CA Foundation and intermediate examinations. Moving on, now like in the previous slide, you heard me say live and recorded sessions. So if you're wondering what those live and recorded sessions are, those live and recorded sessions are your live and recorded special classes and live and recorded plus courses. And if you're wondering where they are available on an app known as the Unacademy Learning app. So for those of you who have downloaded the Unacademy Learning app and are using it, I thank you very much, and I request your support in the future as well. For those of you who have not yet downloaded and registered on the Unacademy Learning app, I request you to go to the Play Store on your mobile phones, download the Unacademy Learning app, install the Unacademy Learning app on your phones, put in your mobile number where you will get an OTP, and using that OTP you can register on the Unacademy Learning app. It is as simple as that, with no lengthy or complicated procedures. So your next question might be, okay, you have downloaded, installed and registered on the Unacademy Learning app, so what's next? So let me tell you that the Unacademy Learning app gives you access to all the live and recorded special classes that Unacademy has to offer to you to help you in your preparation for the CA Foundation and intermediate examinations. And it also gives you access to all the live and recorded plus courses that Unacademy has to offer to you in order to accelerate and enhance your preparation for the CA Foundation and intermediate examinations. So keeping all these points in mind, I request you to download, install and register on the Unacademy Learning app as soon as possible in order to make use of the world of resources that Unacademy has to offer to you to help you in your preparation for the CA Foundation and intermediate examinations. Alright? Okay, now moving on to an important slide. Like I told you, the Plus platform of Unacademy is the premium platform of Unacademy, that is a payment-based subscription model, and which provides various subscription packages for the various examinations. So accordingly, the CA Foundation and the intermediate subscription packages provided by the Plus platform of Unacademy are as follows. The packages provided are for 1 month, 3 months, 6 months, 12 months and 24 months. The 1 month package will cost you rupees 3,500. The 3 month package will cost you rupees 8,750. The 6 months package will cost you rupees 14,000. The 12 months package will cost you rupees 17,500. And the 24 months package will cost you rupees 21,000. Now please remember, all these are the listed price of the packages. So before you make the payment for the package of your choice, please do not forget to use the code Prathik to get an instant discount of 10% on the above listed price. I repeat, please do not forget to use the code Prathik to get an instant discount of 10% on the above listed price. The after discount price of the various packages are as follows. The 1 month package will cost you rupees 3,150. The 3 month package will cost you rupees 7,875. The 6 months package will cost you rupees 12,600. The 12 months package will cost you rupees 15,750. And the 24 months package will cost you rupees 18,900. So you see, immediately you get a savings or discount of 10% when you use my code Pratik. Now there is an important announcement. This 10% discount is being reduced to 5% from 1st of March 2021. So that means this 10% discount is applicable till the end of day on February 28, 2021, after which it is being reduced to 5%. So all of you who have decided or are thinking about joining the Plus platform of Unacademy but haven't done so already, this is the time for you to do it, to avail the discount of 10%. And while doing so, please do not forget to use the code Pratik to get an instant discount of 10%. So I would personally recommend you to start off with the 12 months or 24 months package because of two reasons. Firstly, it's cost effective. If you compare the 1 month package with the per month cost of the 6 months and 12 months packages, you will see that you're getting great cost savings almost immediately. And secondly, and most importantly, since the CA Foundation and Intermediate course is provided to you in one package, that is 12 months or 24 months, a 12 months or 24 months package will be highly beneficial to you because it covers the duration of both your courses, that is CA Foundation and Intermediate, which normally take a minimum of about 12 months for you to prepare and clear. So if you're getting a package that is 12 months or 24 months that covers the duration of your CA Foundation and the Intermediate course at a very cost-effective price, I think that is a very good deal. But having said this, you're free to choose the package of your choice. But before you make the payment, please do not forget to use the code Pratik to get an instant discount of 10% on the above listed price. Okay, you can also make use of the no-cost EMI option available for the 6 months, 12 months and 24-month subscription packages, just in case you do not wish to make the entire payment at one shot. The other payment options available to you are internet banking, debit card, credit card, and also all the coins that you've accumulated by watching the special classes can be redeemed while making the payment for the Plus course. So keeping all these packages, incentives and discounts in mind, and the advantages I told you a couple of slides earlier in mind, I strongly recommend and encourage you to become part of the Plus platform of Unacademy as soon as possible in order to accelerate and enhance your preparation for the CA Foundation and intermediate examinations. Alright, let's move on. Like I told you, the Unacademy Learning app gives you access to all the live and recorded special classes. Here are the snapshots of few of the many special classes that I have conducted on the Unacademy Learning app, which you can make use of in your preparation for the CA Foundation and intermediate examinations. There are special classes on revision test papers, the Sale of Goods Act, the Indian Contracts Act, the Companies Act, Fundamentals of Accounting, Revision on Partnership Account Retirement, Death of Partner, Admission of Partner, Valuation of Inventories, Revision on Final Accounts of Entities, Revision on Sale of Goods on Approval or Return Basis, and many more. So all you need to do is log into the Unacademy Learning app, go to my profile Prathik Gupta, so that you can make use of the hundreds of hours of special classes that I have taken there exclusively for your benefit. Okay? Alright, let's move on. Also, here are the links to few of the many special classes that I have conducted on the Unacademy Learning app. You can either click on these links or copy and paste these links on your browser to take you directly to the special class on the Unacademy Learning app, where you can make use of it. There are special classes on Indian Contracts Act, the Sale of Goods Act, the Indian Partnership Act, the Limited Liability Partnership Act, the Companies Act, Basics of Communication, Accounting Concepts, and Revision Test Papers, and many more. So like I told you earlier, please log into the Unacademy Learning app, go to my profile, Prathik Gupta, and start making use of the numerous number of hours of special classes that I have taken on the Unacademy Learning app. Alright, just take about 30 seconds, go through this, and then we proceed. Okay, let's start off with the Negotiable Instruments Act 1881. Okay, so this is also an important chapter in your laws syllabus for CA Intermediate, where we talk about negotiable instruments. Negotiable instruments are those instruments where you make a payment through an instrument. You don't make a payment in cash, but through a credit instrument. It could be a check, it could be a promissory note, it could be a bill of exchange. Okay, these days promissory notes and bill of exchange are not used very widely, but checks are used very widely. So this chapter, and you can see it is 1881, so it's been there for quite a while. So it will cover all the important aspects of your transactions. Alright, so let's move on. Okay, now let's look at the introduction quickly. The law relating to negotiable instruments is the law of commercial world, which was enacted to facilitate the activities in trade and commerce, making provision of giving sanctity to the instruments of credit. Now, credit was very important because please remember there is very limited transactions you can do on cash or immediate payment basis, and for business to grow or for your turnover or your other things to grow, it's very important that you make transactions on credit as well. So that's the reason why a lot of negotiable instruments or credit instruments were introduced, which enables business houses to carry on business in credit, which would be deemed to be convertible into money and easily passable from one person to another. In the absence of such instruments, the trade and commerce activities were likely to be adversely affected, as it is not practicable for the trading community to carry out with it the bulk of currency in force. Okay, so that means you cannot carry out all your transactions by currency. The source of Indian law relating to such instruments is admittedly the English common law. The main objective of the Act is to legalize the system by which instruments contemplated by it could pass from hand to hand by negotiation like any other good. So in short, this whole paragraph simply means in order to encourage the Credit Transactions in Businesses, the Negotiable Instruments Act, 80D. What was brought into existence? Please take a minute, go through this. Any questions? Please ask me. Any questions you may have, please ask me. Come on. Are we done? Please take another minute. Carefully go through this. Okay, now, recent developments. The Act was amended several times. Recent three amendments made in the Negotiable Instruments Act were the Negotiable Instruments Amendment and Miscellaneous Provisions Act 2002 and the Negotiable Instruments Amendment Act 2015 and the Negotiable Instruments Amendment Act 2018. So if you see, it was an act from 1881. So after that, the recent amendments were made in 2002 and again in 2015 and then again in 2018. Obviously, it has to be kept up to date. The Negotiable Instruments Act, Amendment Act 2018 received the assent of the President and was notified in the official gazette on 2nd August 2018 and came into effect from September 1st, 2018. Okay? The Amendment Act 2018 contains two significant changes. The introduction of Section 143A and Section 148. These sections provide interim compensation during the pendency of criminal complaint and criminal appeal. So what is the major changes in the amendments in the 2018 Amendment Act is there are introduction of two sections, that is Section 143A and Section 148, where they give interim compensation during the pendency of any criminal complaint and criminal appeal by an aggrieved party. Okay? Alright, please take about 2 minutes, go through this. Any questions, please ask me. Come on. Any questions, please ask me. Please take another couple of minutes. Come on, let me know once you're done. Okay, the meaning of negotiable instruments. Let's go to this. The meaning of negotiable instruments. Negotiable instrument is an instrument. The word instrument means a document which is freely transferable by customs of trade. Customs of trade means by usage in trade. From one person to another by mere delivery or by endorsement and delivery. The property in such instrument passes to the bona fide transferee for a value. So let's take for this argument or for discussion purposes a check. When you buy something from a person, you can either pay him by cash, or if he accepts check, you can give him a check. It's a piece of paper on which you write the name of the person to whom you are paying, the amount, and you sign. Then that person can go and deposit it into his bank, and the money will be transferred from your bank to his bank, or he can go and withdraw cash from the bank. Alright, so that is a negotiable instrument. The Act does not define the term negotiable instruments. However, Section 13 of the Act provides for only three kinds of negotiable instruments, namely bill of exchange, promissory notes, and checks, payable either to the order or to the bearer. So in this chapter, we are going to talk about only three negotiable instruments. Now, what are those three negotiable instruments? We are going to talk about promissory notes, bill of exchange, and checks. Let me tell you, promissory notes and bill of exchange are not very widely in use now. Today, we use mainly checks. But earlier, as you saw, the Negotiable Instruments Act is from 1881. So the promissory notes and bill of exchanges also were there in existence at that point. But mainly we are going to talk about checks. We are going to discuss all three, but please remember in today's era, most applicable is a check. Please take 2 minutes, go through this. Any question, please ask me. Come on. Please take a couple of minutes, go through this. I'm giving you time so that you can read it and ask me any questions that you may have. Come on. Any questions, please ask me. Take another couple of minutes, please. Come on, go through this carefully. Take another minute. Any questions, please ask me. Come on. Let me know once you're done. Take about 30 seconds more. Come on. Are we done? Okay, now let's move to this. Essential characteristics of negotiable instruments. Now listen to this carefully. Firstly, it is necessarily in writing. So in negotiable instruments, there are no oral negotiable instruments. Okay, it has to be in writing. Those negotiable instruments have to be in writing where it has the name of the person who has drawn it, on whom it is drawn, the date and everything. It should be duly signed. That means a negotiable instrument which is not signed is not approved. Okay, not signed means not valid. Okay, it is freely transferable from one person to another. So if I issue a check to you, you can endorse the check to someone else. Okay, so it is possible for you to do that as well. Okay, then it is freely transferable from one person to another. Holder's title is free from defects. So whoever is holding the negotiable instruments, his title is free from defects. Okay, no one can question his title. If his name is mentioned on this, no one can question his title. It can be transferred any number of times till its satisfaction. So a negotiable instrument can be transferred from person to person, person to person, person to person until its final satisfaction, until its final payment or encashment. Okay. Every negotiable instrument must contain either a promise or an order to pay money. Also, the promise or order must be unconditional. So any negotiable instrument, whether it's bill of exchange, promissory note or check, shall either contain a promise to pay or an order to pay money. Okay, and also the promise or the order has to be unconditional. There should be no condition attached in a Negotiable Instruments Act. Negotiable instrument. The promise or order to pay must consist of money only. Nothing should be payable, wherein the addition or in substitution of money. Also, the sum payable must be certain. Okay, so you cannot say pay some money or pay whatever money he demands. The sum of the money mentioned in the negotiable instrument should be certain, and the promise should contain only to pay money. You cannot say pay 4 trees to him or 4 tomatoes to him or 4 potatoes to him. It has to be money. Nothing should be payable whether in addition or to substitution of money. Also, the sum payable must be certain. Okay, so these are a few essential characteristics of negotiable instruments. Please take 2 minutes, go through this. Any questions? Please ask me. Take glasses. Any questions? Please ask me. Come on, take another minute. Carefully go through this. This is an important question. Come on, carefully go through this. Any questions? Please ask me. Let me know once you're done, please. Come on. Take another minute. Carefully go through this. Please take a minute, go through this carefully. Any questions you may have, please ask me. Come on. These are the essential characteristics of negotiable instruments. Take about 30 seconds more, then we proceed. Okay, any questions? Please ask me, any of you. Are we done? Okay, now presumptions. Now this is an important one. Presumptions as to negotiable instruments. Okay, so presumptions made in relation to negotiable instruments and presumptions drawn. Okay, so presumptions made in relation to consideration. Every negotiable instrument was made or drawn for consideration. What do you mean by consideration? It could either be to do something or a promise to do something, pay something or a promise to pay something. So a negotiable instrument is drawn. So the presumption about a negotiable instrument is that every negotiable instrument was made or drawn for some consideration, whereas some person had to pay something to someone. So it was drawn only for that. As to date, every negotiable instrument bearing a date was made or drawn on such date. So if you see a check, so I'm talking about checks, the check will have on the right hand top column, it will have a space to put the date. That means the date on which your check is drawn, right? So every presumption made in relation to a date will mean every negotiable instrument bearing a date was made or drawn on such dates. There is also a concept of PDC, post-dated checks. For example, today is, what is the date today? Today is 16th Feb. So if I'm giving you a check for 20th Feb, you cannot deposit the check before 20 Feb. So on 20 Feb, when you deposit the check in your bank, it will be presumed that it was drawn on 20th Feb and not before that. Then the presumption made in relation as to time of acceptance. The presumption drawn is that every accepted bill of exchange was accepted within a reasonable time after its date and before its maturity. Now, what is the maturity period of a check? The maturity period of a check earlier used to be 6 days from the date on which it is, 6 months from the date on which it is drawn, but now it's been reduced to 3 months from the date it is drawn. So, a presumption as to the time of acceptance means every accepted bill of exchange was accepted within a reasonable time after its date and before its maturity. Okay, then the presumption made in relation to as to time of transfer, every transfer of a negotiable instrument was made before its maturity. So like we saw in the previous slide, a negotiable instrument can be transferred from one person to another, one person to another, one person to another by endorsement until its final satisfaction, right? So whenever a negotiable instrument is transferred from one person to another, it can be presumed that such transfer of the negotiable instrument has been done before its maturity. Okay, that is currently 3 months for a check. Then the presumption made in relation to as to order of endorsements. Endorsements appearing upon a negotiable instrument were made in the order in which they appear. Endorsement again will mean the transfer of a negotiable instrument from one person to another for another. That is done by endorsement. So whatever sequence the name of the people is written, it is presumed that the transfer or endorsement is made in that particular sequence as mentioned on the negotiable instrument. Then the presumption made in relation to stamps. Lost promissory note, bill of exchange checks were duly stamped. So then the presumption is that if any bill of exchange is lost or this thing, then that was duly stamped. We can make the presumption. And then the last presumption is presumption in relation as to holder. The holder of a negotiable instrument is a holder in due course. That means he got the negotiable instrument or he got in possession of the negotiable instrument in due course and he is the valid owner or holder of the negotiable instrument. Okay. Please take about 2 minutes. Go through this. Any questions? Please ask. Any question? Please ask. Come on. Please take 2 minutes. Carefully go through this. This is an important slide. Any questions? Please ask me. Come on, let me know once you're done. Come on, take a couple of minutes, go through this. Any questions, please ask me. This is an important slide. Come on. Please take another minute. Any questions, please ask me. Go through this carefully, please. Any questions, please ask me. Come on. Any questions, please ask. Take another minute. Are we done? Okay, now let's start off with what do you mean by a promissory note. Okay, according to Section 4 of the Negotiable Instruments Act 1881, a promissory note is an instrument in writing, not being a banking note or currency note, containing an unconditional undertaking signed by the maker to pay a certain sum of money only to or to the order of a certain person or to the bearer of the instrument. Okay, so basically, as per Section 4 of the Negotiable Instrument Act, a promissory note is an instrument in writing which contains a promise made by the maker. The person who makes the promissory note is known as the maker, agreeing to pay a certain sum of money to or to the order of a certain person or to the bearer of the instrument. Okay, so that there are three things. It could be pay a certain sum of money only to or to the order of or to the bearer of the instrument. The person who makes the promise to pay is known as the maker. Here, he is the debtor and must sign the instrument. The person who will get the money is known, the creditor is known as the payee. So there are two parties in a promissory note. One is the payer who makes the promissory note, and to whom it is given is known as the payee. So the maker of a promissory note makes an undertaking, is a promise to pay the payer, okay, a certain sum of money. Okay, so basically the maker is promising to pay a certain sum of money to the payee, or to the order of the payee or to the bearer of the instrument. So that is what you mean by a promissory note. Please take a minute, carefully go through this. Any questions, please ask me. Come on, any questions, please ask me. Please take a minute. This is the promissory note. Come on. Any questions? Please ask me. Take another minute, please. Come on, any questions? Please ask. Are we done? Come on, let me know once you're done, please. Okay, now let's look at the essential characteristics of a promissory note. Again, like every negotiable instrument, it has to be in writing. So a promissory note in oral promise is not sufficient to enforce in law. It has to be in writing. There must be an express promise to pay. Mere acknowledgement of debt is not sufficient. So the maker of the promissory note shall make a promise that I promise to pay B sum of amount and so and so, so and so, so and so. A mere acknowledgement of debt, that saying that I owe B rupees 500 is not a promissory note. There should be a promise that the maker of the promissory note is agreeing or acknowledging to pay the debt to B, the payee, on a particular date. Example, I acknowledge myself to be indebted to B for rupees 1000 and to be paid on demand for value received. Valid promissory note as the promise to pay is definite. Okay, so the maker is promising to pay. That is on demand. Now another example, Mr. B, I owe you. Mr. B, I owe you rupees 1000. So if a maker of a promissory note simply mentions there, Mr. B, I owe you rupees 1000, it is an invalid promissory note as there is no promise to pay. It is just an acknowledgement of debt that okay, I agree, I have to pay you 1000. Now when you are paying it, by what date you will pay it, nothing is mentioned. C. The promise to pay should be definite and unconditional. Therefore, instruments payable on performance or non-performance of a particular act or on the happening or non-happening of an event are not promissory notes. So please remember, when you're making a promissory note, there should be an unconditional promise by the maker of the promissory note to pay the payee of the promissory note a certain sum of money on a particular date. Okay, it should not be based on any conditions. The maker of the promissory note has no right to include any conditions in it. That okay, I have to pay you rupees 1000 and I promise to pay you rupees 1000 after 1 week, so and so, provided you provide this to me, or you come and clean my house, or you come and empty this place, or whatever. So there can be no conditions whenever a promissory note is made by the maker of the promissory note. However, the promise to pay may be subject to a condition which, according to the ordinary experience of mankind, is bound to happen. Okay, so normally it cannot be conditional, but there could be one condition attached which in the ordinary experience or ordinary usage of trade is valid. Okay, please take 2 minutes, go through this. Any questions? Please ask me. Any questions? Please ask. Come on. Any questions? Please ask me. Please take another minute. Any questions? Please ask me. Come on, any questions? Please ask me. Take another 30 seconds. Let me know once you're done, please. Are we done? Come on, take another minute, please. Carefully go through this. Okay, now let's have a look at a few examples. Example, I promised to pay B rupees 500 7 days after my marriage with C. The promissory note is not valid. The promissory note is invalid as marriage with C may or may not happen. Okay, so it's a very contingent event. Okay, so such contingent conditions you cannot put. Let's take the next example. I promise to pay B rupees 500 on D's debt. As the debt of D is certain, promise is unconditional, thus the promissory note is valid. Now, whatever happens, the most certain thing in life today is that everyone who is born has to go one day or the other. So, if there is any promissory note based on the instance saying that I promise to pay B on the death of D, then it is an unconditional promise because D will die someday or the other, thus the promissory note is valid. Then, next example, I promise to pay B rupees 500 on D's debt provided D leaves me enough money to pay that sum. Invalid promissory note as promise is dependent on D leaving behind money which is not certain, which may or may not happen. It's again a contingent condition. D may leave behind 500 rupees or may not leave behind 500 rupees. So it is a promissory note based on a condition that may or may not happen. Then the next condition of a promissory note is a promissory note must be signed by the maker, otherwise it is incomplete and ineffective. So whenever you issue a check, if the check is unsigned, can you enforce it in the court of law? No, you cannot enforce it in the court of law. So your bill of exchange or promissory note should be signed by the maker. Then the last condition is the essential characteristic. It should be only a promise to pay money, not anything else. You cannot promise to give goods, or you cannot promise to give your house, or you cannot promise to give anything else. It should be made. It should promissory note should contain a promise to pay money only. Example: I promise to pay B rupees 500 and to deliver to him my black horse on 1st January next. It is not a valid promissory note, as the promisor needs to deliver his black horse, which is not money. So there should be a promise exclusively to deliver money and nothing else. Okay, please take 2 minutes, go through this. Any question, please ask me. Any questions, please ask me. Take a minute more. Come on. Any questions, please ask me. Come on. Any questions, please ask me. Take another minute more, please. Carefully go through this. Take another minute, please. Are we done? Okay. Then, the next essential characteristic, it should be a promise to pay a certain sum. The sum should be certain. It should not be vague. That I promise to pay B some sum of money after a week. No, there should not be some sum of money. The amount of money that he is promising to pay should be certain. Example, I promise to pay B rupees 500 and all other sums which shall be due to him. This all other sums is not certain, right? This all other sums could mean a lot of things. So this makes the promissory note invalid. Promissory note is invalid as the amount payable is not certain. See, 500 is payable, is certain, it's okay. But this whole thing saying all other sums, that makes the promissory note uncertain. So it is an invalid promissory note. The next essential characteristic of a promissory note is the maker and payee must be certain, definite and certain persons. A promissory note cannot be made payable to the bearer, that is section 31 of the RBI Act. Only the Reserve Bank or the central government can make or issue a promissory note payable to the bearer. Okay? So what I am saying is the maker and the payee must be certain. So when a person who's making a promissory note, he cannot say, I promise to pay someone rupees 500 after a week. That someone has to be certain. And please remember, a promissory note cannot be made payable to a bearer. That means whoever is holding the promissory note, please pay that amount. That is not permissible as per section 31 of the RBI Act. Only the Reserve Bank or the central government can make or issue a promissory note that is payable to a bearer. Otherwise, it has to be a particular person to whom the money has to be paid. Okay, it cannot be made payable to a bearer. Then the last essential characteristic of a promissory note is stamping. A promissory note must be properly stamped in accordance with the provisions of the Indian Stamp Act, and such stamp must be duly cancelled by the maker's signature or initial. So every promissory note will have to be stamped as per the Indian Stamp Act. You will have to pay some stamp duties, and then that stamp has to be cancelled by the initials or the signature of the makers of the promissory note. Otherwise, that stamp can be used again. Okay, now if you see checks, in checks do you require any stamping? No, you don't require. So slowly the negotiable instruments have evolved. Okay, earlier the promissory notes, the bill of exchange required stamping, but a check does not require stamping. But here we are talking about a promissory note. So a promissory note requires stamping, and that stamp should be cancelled by the maker of the promissory note. Come on. Please take 2 minutes, go through this. Any questions? Please ask. Any questions? Please ask me. Come on. You want to take another minute, please? Go through this carefully. Any questions? Please ask. Come on. Any questions? Please ask me. Take another minute, please. Go through this carefully. Are we done? Are we done, please? Okay, let's move on. Now, so far we discussed about a promissory note. Now, quickly let's go through what a bill of exchange is. Please remember, under this Negotiable Instruments Act 1881, we are talking about 3 negotiable instruments: a promissory note, a bill of exchange, and a check. Okay, so a bill of exchange is an instrument in writing containing an unconditional order signed by the maker, directing a certain person to pay a certain sum of money to or to the order of a certain person or to the bearer of the instrument. So, what is a negotiable instrument? A bill of exchange. A bill of exchange is an instrument in writing. Again, it contains an unconditional order. It is signed by the maker of the bill of exchange. So whoever makes the bill of exchange, it is signed by him. It is directing another third person, certain person, to pay a certain sum of money to or to the order of another certain person or to the bearer of the instrument. So that is what you mean by a bill of exchange. So basically, okay, there are three parties involved in a bill of exchange. One is the drawer or the maker of the bill of exchange. He draws it on another third party, that is B, who is the drawee, and he instructs B to pay a certain sum of money to or only to the order of a third person, which is C, the payee. So there is a drawer, there is a drawee, and there is a payee in a bill of exchange. Now the parties to a bill of exchange. First party to a bill of exchange is the drawer. The drawer is the maker of the bill of exchange. Whoever makes the bill of exchange is known as the drawer of the bill of exchange. Then we have the drawee. The person directed by the drawer to pay is known as a drawee. He is the person on whom the bill is drawn. On acceptance of the bill, he is called as an acceptor and he is liable for payment of the bill. His liability is primary and unconditional. So basically, the drawer of a bill of exchange will draw it on a person known as a drawee, okay, and instruct him to pay a certain sum of money to someone or to the order of someone, the certain third person, and that third person is known as the payee. The person named in the instrument is known as the payee, to whom or whose order the money is to be paid by the instrument or directed or to be paid is known as the payee. Okay, so there are three parties to a bill of exchange. Firstly, what is a bill of exchange? A bill of exchange is an instrument in writing containing an unconditional order signed by the maker, directing a certain person to make a certain sum of money or to the order of a certain person or to the bearer of the instrument. So there are three parties here. Who are the three parties? The drawer, the person who makes the bill of exchange, the drawee on whom the bill of exchange is drawn, and instruction is given by the drawer that please pay the sum of money to so and so person or the order of so and so person. Okay, and then the third person is C. C is the person to whom the money is paid by the drawee on the order of the drawer. Okay, so are you clear about these three people involved in the parties to a bill of exchange? Yes, please take a minute, go through this. Any questions? Please ask me. Any questions? Please ask. Come on, please take a minute. Any questions you may have, please ask me. Let me know once you're done, please. Please take another minute. Let me know once you're done. Carefully go through this piece. There's a difference between a promissory note. Promissory note, there were two parties, maker, payer and payee. In bill of exchange, you have three parties, drawer, drawee and payee. Okay, this is an important question from your exam point of view as well. Please take another minute, carefully go through this and let me know once you're done. Okay, taking now 30 seconds. Let me know once you're done, please. Are we done? Any questions, anyone, please? Come on. Okay, let's move on. Now let's look at the essential characteristics of bill of exchange. So we also saw the essential characteristics of promissory note. So similarly, let's look at the essential characteristics of bill of exchange. Firstly, like every negotiable instrument, it must be in writing, so not oral, verbal or otherwise. Okay, so even a bill of exchange has to be in writing. So an oral bill of exchange or a verbal bill of exchange or otherwise is not valid, it has to be in writing. The bill of exchange must contain an express order to pay. So the drawer should draw the bill of exchange on the drawee, and it shall contain an express order to pay a certain sum of money to the payee, or to the order of the payee, or to the bearer of the instrument. The order must be definite and unconditional. There should be no conditions attached, and it should not be vague. It should be a definite order that please pay certain so much, 500, 600, 1000, 10,000, 2 lakhs to so and so person, or to the order of so and so person. The drawer must sign the agreement, similar instrument. Okay, unsigned is invalid. Okay, then the drawer, drawee and payee must be certain. They should not be fictitious persons. All these three parties may not necessarily be three different persons. One can play the role of two, but there must be two distinct persons in any case. As per section 31 of the RBI Act, the bill of exchange cannot be made payable to the bearer on demand. Okay, so like we discussed earlier, as per section 31 of the RBI Act, a bill of exchange cannot be made payable to the bearer of demand. Only the RBI or the central government can issue a bill of exchange which is payable on demand. Then the sum mentioned in the bill of exchange must be certain. You cannot draw a bill of exchange to pay some amount of money to third person. It should be specific and fixed, 500, 5 lakhs, 5,000, whatever. The order must be to pay money only. You cannot order someone to give goods. The order to pay must be money only, nothing other than money. Like your promissory note, even your bill of exchange should contain an order to pay money only and nothing else. And then it must be stamped. Just like your promissory note, your bill of exchange should also be stamped via as per the Indian Stamp Act. Okay, so these are the essential characteristics of a bill of exchange. Please take 2 minutes. Go through this. Any questions you may have, please ask me. Any questions? Please ask me. Please take a couple of minutes. Carefully go through this. Come on. Any questions you may have, please ask me. Come on. Let me know once you're done, please. Take another minute. Any questions? Anyone? Okay, take about 30 seconds more, then we proceed. Okay, are we done? Okay, any questions? Alright, now let's look at an important slide, which is the difference between promissory note and bill of exchange. This is an important slide from the exam point of view as well. So please pay attention, okay? Now we have 4 differences. The bases are definition, nature of instrument, parties and acceptance. Definition. Promissory note is an instrument in writing, not being a banknote or a currency note, containing an unconditional undertaking signed by the maker to pay a certain sum of money only to or to the order of a certain person or to the bearer of the instrument. So what is it? It is an instrument made by the maker, which is which contains an unconditional undertaking or promise to pay a certain sum of money to or to the order of a certain person or to the bearer of the instrument. Okay, that is the definition. Whereas a bill of exchange is an instrument in writing containing an unconditional order, not a promise, signed by the maker directing a certain person to pay a certain sum of money only to or to the order of a person. So, what's the first difference? A promissory note is an unconditional promise, whereas a bill of exchange is an unconditional order directing another third person to make another payment to or to the order of another person or to the bearer of the instrument. Okay, so that's your definition. Then comes your second part, nature of instrument. In a promissory note, there is a promise to pay money. Okay, in a bill of exchange, there is an order for making payment. Like I told you, promissory note means there is an unconditional promise, but whereas in a bill of exchange, there is an unconditional order for making payment. Parties, in a promissory note, there are only two parties, namely the maker and the payer or the payee. Okay, the payer and payee. But in a bill of exchange, there are three parties which are as follows: the drawer, the drawee, or the payee. Then comes your acceptance. A promissory note does not require any acceptance as it is signed by the person who is liable to pay. Okay. So, like we say, promissory note is where one person is promising to pay money to someone or to the order of someone. So, there's nothing like acceptance. But in a bill of exchange, there needs to be an acceptance from the drawee because the drawer draws it on the drawee accepts it, and based on the instructions of the drawer, then makes the payment to or to the order of the payee. Okay, so a bill of exchange needs acceptance. So these are your four major differences between a bill of exchange and a promissory note. Okay, first one is the definition. Second one is in a promissory note, there is a promise to pay money, but in a bill of exchange, there is an order to making payment. There are two parties in a promissory note, the maker and the payee, whereas in a bill of exchange, there are three parties, which are as follows: the drawer, the drawee, and the payee. In a promissory note, there is no need for acceptance because it is an unconditional promise made by the maker. But in a bill of exchange, there has to be an acceptance by the drawee on whom the bill of exchange is drawn. Okay, please take 2 minutes, go through this. Any questions, please ask me. Any questions, please ask me. Let me know once you're done, please. Let me know once we're done. Please take another minute. Come on. Any questions, please ask. This is an important question from the exam point of view as well. Any questions, please ask me. Come on. Let me know once you're done. Come on, come on, come on. Take another minute. Carefully go through this. If you want, make a note of it. And then we proceed. Come on. Are we done? Okay, now let's look at the third kind of negotiable instrument. Now we've discussed about a promissory note, we've discussed about a bill of exchange. Now let's look at the check. Now I'm sure that everyone can relate to a check which is widely used today, right? Maybe a bill of exchange and a promissory note is not widely used today, but a check is definitely widely used today. So we will be able to relate to it much better. But slowly, actually, even the usage of checks are going down because of your IMPS, NEFT, and RTGS, and all your transactions, Google Pay, and various other platforms which you make online payment. Because of which now even the payment by checks is coming down. So a check is a bill of exchange drawn on a specific banker and not expressed to be payable otherwise than on demand, and it includes electronic image of the truncated check and a check in the electronic form. Okay, so now how is it different from a bill of exchange? A bill of exchange is drawn by the drawer on a particular person, drawee, who accepts it, and then he makes the payment to the payee. So like similarly, a check is always drawn on a banker. Okay, it is not drawn on any other person like a drawee or anything. It is drawn on a banker and not expressed to be payable otherwise than on demand. So a check has to be paid only on demand. So whoever you have given the check, unless he goes and demands the payment from the bank will not pay it, and he has to make the demand within the validity period of a check, which is 3 months. And it includes electronic image of a truncated check and a check in electronic form. So what are the various characteristics of this definition? The check is a bill of exchange which is drawn on a specified banker. We have hundreds of banks today, so on anyone, and it is always payable on demand. Okay, so let's say if today is 16th Feb and I issue a check to you, the validity is from 16th Feb to 3 months. So within that 3 months, whenever you want the money, you can go and present it to your bank. Your bank will send a truncated image of the check to my bank. My bank will approve it, and then the money will be transferred from my bank to your bank. That is how the transfer in checks happen. Okay, so the payable on demand means it should be payable whenever the holder chooses to present it to the drawee. So within the validity period of 3 months, whenever the holder of the check chooses to take the money, he has to present it to the drawee bank. Okay, then the expression banker includes any person acting as a banker and for any post office savings account. So your banks could be ICICI, SBI, PNB, HDFC, or any of the banks that you name it today. You have 100 banks today. And it also includes any post office savings account. Please remember, a lot of you may not be aware, but even the post office enables you to open a savings account in the post office and gives you a checkbook and other things, same like your banking facilities. So you can also issue a check from the post office savings account. Okay, please take a minute, go through this. Any questions, please ask me. Any questions you may have, please ask me. Take a minute, please. Come on. Please take a couple of minutes, carefully go through this. Any questions you may have, please ask me. Come on and let me know once you're done, please. Any questions? Please ask. Carefully go through this. Take another minute. Are we done? Okay, take about 10 more seconds, then we proceed. Okay, let's move on. Now let's look at some explanations. Okay, explanation 1. For the purpose of this section, the expressions check in electronic form means a check drawn in electronic form by using any computer resource and signed in a secure system with a digital signature, with or without biometric signature, and a symmetric crypto system of or electric signature as the case may be. Okay, so like I told you, whenever I issue a check to you, you can deposit the check in your bank. Your bank will take a truncated or an electronic image of that check along with my signature and send it to my bank. Then my bank will check the details, the signature, dates, the amount in my bank balance, and if it's all okay, they will approve it, and then the money will be transferred from my bank to your bank. So, for the purpose of this section, the expression check in truncated electronic form means a check drawn in electronic form by using any computer resource. These banks have a lot of these softwares, and signed in a secure system with a digital signature, with or without biometric signature, and asymmetric crypto system or electronic signature as the case may be. So a check could be, when the electronic image of the check is being transferred between banks, it could have the actual signature or it could have the digital signature as the case may be of the authorized person. Note, for the purpose of this section, the expressions asymmetric crypto system, computer resource, digital signature, electronic form, and electronic signature shall have the same meanings respectively assigned to them in the Information Technology Act 2000. Alright, so this is clear. Next, a truncated check. What do you mean by a truncated check? A truncated check means a check which is truncated during the course of a clearing cycle, either by the clearing house or by the bank, whether paying or receiving the payment immediately on generation of the electronic image for transmission, substituting the further physical movement of check. So like again I told you, when I issue a check to you, your bank will take a truncated or an electronic image and send it to my bank for verification. They have various softwares to ensure that the authenticity of the check is maintained. Then my bank will check the details and everything, and then if it's found okay, it will transfer the money. If it is not found okay, it will refuse the payment, and that is also known as a bounce of a check. Okay, please take a minute, go through this. Any questions? Please ask me. Any questions? Please ask. Come on. Any questions you may have, please ask me. Please take another minute, go through this carefully. Any questions you may have, please ask me. Any questions, please ask. Come on. Please take 30 seconds more, go through this, and then we proceed. Okay, now let's go to the second explanation. For the purpose of this section, the expression clearinghouse means the clearinghouse managed by the RBI or a clearinghouse recognized as such by the Reserve Bank of India. Now, please remember, every bank normally has a clearinghouse. That whatever checks are being issued on the bank or from the bank, they go to that clearinghouse, central bank, and from there all the amounts are either transferred from that bank or received in that bank. So normally every bank will have a clearinghouse, and this clearinghouse is established as per the rules given by the Reserve Bank of India. Now, explanation 2. For the purpose of this section, the terms asymmetric crypto system, computer resource, digital signature, electronic form, electronic signature shall have the same meanings respectively assigned to them in the Information Technology Act 2000. So, basically, whatever meaning has been given under the Information Technology Act 2000 for asymmetric crypto system, computer resource, digital signature, electronic form, electronic signature, they shall have the same meaning as contained in the Information Technology Act 2000. So the ones who want to know the meaning of this can refer to the Information Technology Act 2000 to know the real meaning of the terms asymmetric crypto system, computer resource, digital signature, electronic form, and electronic signature. Okay, a combined reading of section 5 and section 6 tells us that a bill of exchange is a negotiable instrument in writing containing an instruction to a third party to pay a stated sum of money at a designated future demand or on demand, whereas a check is also a bill of exchange but it is drawn on a banker and payable on demand. So let's take the first one, promissory note. A promissory note is a payer makes an unconditional promise to pay a person or a payee. Okay? Bill of exchange, the drawer makes an unconditional order on the drawee to make a certain payment of certain sum of money or to the order of or to the bearer of the instrument or the order of the third person known as a payee. Okay? But here in a check, there is a person known as a drawer, and the drawer gives an unconditional order on a bank, not any drawee, but on a bank to make the payment to on demand, to make a payment of a certain sum of money on demand to another person known as the payee. Okay, so that's the difference between the three modes of payment. The bill of exchange and a check has three parties each, but the parties are different. A bill of exchange has a drawer, drawee, and payee, whereas a check has a drawer, bank, and payee. Okay, please take a minute, go through this. Any questions? Please ask me. Okay, any questions? Please ask me. Come on. Come on, let me know if you have any questions, please. Any questions whatsoever, please ask. Take another minute. Carefully go through this. Are we done? Okay, take 30 seconds more. Carefully go through this. Any questions you may have, please ask me. Come on. Any questions? All right. Okay, so as we've taken about 90 minutes of continuous classes, let's take a small break for about 5 minutes. So I request everyone to go stretch up, grab something to eat, freshen up, and then come back in 5 minutes. Okay, so we will resume the session exactly at 12:38. Okay, just take a 5 minutes break. Even I go and just freshen up and come back. I'll go to the washroom and come back, take a break for 5 minutes. Alright, I'm back. But let's wait for about 2 or 3 minutes and then we will resume the session. Okay? Freshen up, go stretch a little bit and come back, all of you. And then we will resume the session. Come on, 2 more minutes, then come back, everyone. Come back from your break, we will resume the session. Come on. Come on. Come on, 2 more minutes. Finish your break and come back. Come on, come on, come on. Just a minute remaining. Come back from your break and we will resume the session. Come on. Hmm. Come on, take another minute. Come back from your break, everyone. Come on. Okay. Now, come back. Let's resume the session. Parties to a check. Now let's discuss who are the parties in a check. First is the drawer. The person who draws the check or makes the check debtor, his liability is primary and conditional. Uh, Two, the drawee, the specific bank on whom the check is drawn. He makes the payment of the check. In case of check, the drawee is always the banker. So in the bill of exchange, there was a drawee and a draw. There was a drawer and drawee. But in case of a check, there has to be a drawer, and the drawee always has to be the bank. When you issue a check, you issue the check on your bank. Okay. The drawee in case of need, when in a bill or in any endorsement thereon, the name of any person is given in addition to the drawee to be resorted to in case of need of such person is known as drawee in case of need. Then you have the payee, the person named in the instrument. That is the person in whose favor the check is issued, to whom or to whose order the money is by the instrument directed to be paid is called as the payee. The person may be the drawer himself or a third party. Okay, so please remember in the check the person can make himself the payee also when he is withdrawing money. Okay, so in that case, so the three parties to a check are the drawer, the drawee, which always has to be the bank, and then the payee in whose favor the check is drawn. Okay, please take a minute, go through this. Any questions, please ask me. Any questions, please ask. Come on. Okay, so the parties to a check are the drawer, the drawee, which is always the bank, and the payee in whose favor the check is drawn. Okay, please take a couple of minutes more, carefully go through this, and then we proceed. Read it carefully. Come on. Any questions? Please ask me. Okay, now let's look at the essential characteristics of a check. So we also saw the essential characteristics of the promissory note and bill of exchange. Now similarly, let's have a look at the essential characteristics of a check. According to the definition of a check under section 6, a check consists as a species of bill of exchange. Thus, it should fulfill all the essential characteristics of a bill of exchange. It must be in writing, it must be by the drawer, it must be unconditional, it must be certain. That is, it must be drawn on a specific banker. Whatever bank you have your account in, it should always be drawn on a specific banker. And a check is always payable on demand. Just by issuing a check to the other person, whenever the other person wants within the validity period of the check, he should deposit the check in the bank, and then it becomes payable on demand. And then acceptance. The acceptance of a bill is the indication by the drawee of his assent to the order of the drawer. Section 7 states that an acceptance is a signature of the drawee of the bill who has signed his assent upon the bill and delivered it. Okay, so even a check is drawn on a bank, so the bank gives its acceptance. When does it give it acceptance? When it checks everything is okay, there is the sufficient funds in the bank of the account of the drawer, and then it gives its acceptance. And then once it gives its acceptance, it delivers it. It goes further. Okay, chalo, come on, take about 2 minutes, go through this, and then we proceed. Any questions? Please ask me. Come on. Any questions? Please ask me. Come on. Any questions? Please ask me. Take another minute more, please. Come on, take another minute. Any questions? Please ask me. Come on. Okay, now let's look at who is the acceptor. After the drawee of the bill has signed his assent upon the bill, or if there are more parts thereof than one, upon one of the parts and delivered the same or given notice of such signing to the holder or some person on his behalf, he is known as the acceptor. Thus, an acceptor is the drawee who has signed his assent upon the bill and delivered it to the holder. So, when I draw a check, when I give a check to someone, the other person will present it to his bank, that bank will send it to my bank becomes the drawee, right? So it will check everything and give its acceptance, then it becomes the acceptor. It will give its acceptance to the bank of the payee, that yes, okay, that there is sufficient funds and I will honor the check. So then my bank becomes the acceptor. What do you mean by acceptance of acceptor for honor? Where a bill of exchange has been dishonored by non-acceptance and any person accepts it for the honor of the drawer or any endorser, such person is known as acceptance for honor. The payment which he makes is known as the payment for honor. In other words, it is an undertaking by a third party to accept and pay a bill of exchange that was dishonored, either by non-acceptance, see dishonored by non-acceptance, or by non-payment, see dishonored by non-payment, by the party on whom it was drawn. It is also known as an acceptance supra protest. Okay, so it doesn't matter. How acceptance for honor must take place. A person desiring to accept for honor must, by writing on the bill under his hand, declare that he accepts under protest the protested bill for the honor of the drawer of the particular endorser, whom he names generally. So whenever a person draws a check, and let's say the bank dishonors the check, and another person, because he does not want the check to get bounced, he honors it for the honor of another person, that is known as acceptance for honor. Okay, please take 2 minutes, go through this. Any questions? Please ask me. Please take 2 minutes, go through this. Come on, any questions you may have, please ask me. Please take 2 minutes, go through this. Any questions you may have, please ask me. Are we done? Please take another minute. Come on, take another minute, please. Come on. Okay, now essentials of a valid acceptance for honor. Now these are the essential elements. The holder must consent to the acceptance of honor. The holder cannot be compelled to assent to the acceptance for honor. The bill must be noted or protested for the non-acceptance of a better security. The acceptance for honor can be made by a person who is not already liable on the bill. Drawee of the bill, when he refuses to accept the bill, becomes a stranger. He may therefore accept the bill for honor of the party thereof, thereto. It must be made by writing on the bill. It must be for the whole amount due on the bill. The acceptance must be for the honor of any party already liable on the bill. Acceptance for honor must be made before the bill is overdue. Stranger paying for honor must, before payment, declare before a notary public the party for whose honor he pays, and the notary public must have recorded such a declaration. So these are the basic requirements, essentials of a valid acceptance of honor. From the exam point of view, please don't pay too much attention to this topic. It's not really important, but for your knowledge sake, I'm giving you another minute. Please go through this and then we proceed. Okay, it's just for your knowledge. Come on, please take another minute, go through this for knowledge sake. Any questions you may have, please ask me. Come on. Let me know once you're done, please. Any questions, please ask me. Are we done? Okay, let's move on. Specimen of the acceptance of honor. The acceptor of honor writes as below across the bill as given under the specimens of bill of exchange above. Accepted supra protest or accepted for AB. The rights and liabilities of the acceptor for honor. The acceptor for honor binds himself to all the subsequent parties to pay the amount of the bill if the drawee does not pay. The party for whose honor he accepts to pay the amount at all price, parties are liable to compensate the acceptor for honor for all loss or damage sustained by him in consequence of such acceptance. The liability of an acceptor or honor is conditional. He is liable only if the drawee fails to pay the bill. The bill of exchange should be presented at its maturity to the drawer for payment, and it must be dishonored by the drawer and noted for protest for non-payment to charge an acceptor for honor. The bill must be presented or forwarded for presented to the drawee not later than the next day after the date of his maturity. So basically, an acceptance for honor is when the drawee on whom the bill is drawn rejects or refuses to honor the bill of exchange, and then the bill of exchange is honored or is accepted by another person just to take care of the honor of the drawer. That is known as acceptance of honor. So first the drawee should refuse it, and only then the acceptor for honor can come into the picture. Please take 2 minutes, go through this. Any question, please ask. Come on. Come on, any questions, please ask me. Come on. Carefully go through this. Any questions, please ask. Any questions? Please ask me. Please take another minute. Are we done? Come on. Okay, any questions you may have, please ask me. Come on. Okay, now let's look at what is a holder and holder in due course. A holder, section 8, the holder of a promissory note, bill of exchange, or check means any person who is entitled in his own name to the possession thereof and to receive or recover the amount due from the parties thereto. So, whenever a promissory note, bill of exchange, or check is drawn, it is drawn in the name of someone. So, whoever is that name person there, that person is known as a holder. So, that becomes any person who is entitled in his own name to the possession thereof to receive or recover the amount due thereon from the parties. Example, a person who finds or steals a bearer instrument or takes an instrument under forged endorsement is not a holder. The reason is that the holder of a negotiable instrument must have a right to receive or recover the money thereon from the parties thereto. So, if a person has stolen a bill of exchange, okay, but that means it is not in his name but it is in the name of someone else, then he cannot be the holder because obviously he is not entitled to recover any money from the parties. Similarly, example, an agent holding an instrument for his principal is not a holder. The reason being that although agent can receive payments on the instrument, he has no right to sue on the instrument in his own name. So even an agent receiving money on behalf of his principal is not a holder because again an agent is doing it as a known capacity and he cannot sue in his own name because there is no contract between him and the other person. He is not entitled to receive the money, but the principal is entitled to receive the money. Okay, so that is a holder. Next slide, we will see what is a holder in due course. Holder in due course will mean a person who has been endorsed the negotiable instruments. That is a person, a holder in due course. Please take 2 minutes, go through this. Any questions, please ask me. These are important terminologies you need to know. Okay? Come on. Any questions, please ask me. Come on. Take 2 minutes. Any questions you may have, please ask me. Take another minute more. Carefully go through this. Who is the holder? Any questions, please ask. Take another minute, please. Go through this carefully. Any questions you have, please ask. I'm giving you time to read, understand, and ask me any questions you may have. Are we done? Okay, now let's look at a holder in due course. A holder in due course means any person who, for consideration, became the possessor of the promissory note, bill of exchange, or check if payable to bearer, or the payee or endorser thereof if payable to order, and before the amount mentioned in it became payable, and without having sufficient cause to believe that any defect existed in the title of the person from whom he derived the goods. So basically, a holder in due course means any person who, before the maturity of a negotiable instrument, quite validly, for some consideration, became the holder of that instrument by means of a endorsement. Okay, let's take an example. A draws a check for rupees 5,000 and hands it over to B by way of gift. B is a holder but not a holder in due course, as he does not get the check for value for consideration. His title is good and bona fide. As a holder, he is entitled to receive 5,000 from the bank on whom the check is drawn. So in this case, it is simple. A draws a check on B and hands it over to B by way of gift. So B becomes a holder. He is not a holder in due course. Now let's look at what a holder in due course is. On a bill of exchange for rupees 1 lakh, X acceptance to the bill is forged. A takes the bill from his customer for the value and in good faith before the bill becomes payable. State with reasons whether A will be considered as a holder or in due course and whether he can receive the amount of the bill from X. So that is the question. Let's look at the answer. According to Section 9 of the Negotiable Instruments Act 1881, holder in due course means any person who for consideration becomes the possessor of a promissory note, bill of exchange, or check if payable to bearer or payable to endorsee thereof, if payable to order before the amount in it becomes payable and without having sufficient cause to believe that any defect existed in the title of the person from whom he derived this title. As A in this prima facie becomes a possessor of the bill of value and in good faith before the bill became payable, he can be considered as a holder in due course. So it simply means a holder in due course, we are going through all this, a holder in due course simply means whenever a bill of exchange is endorsed validly to another person and the other person without any belief or knowledge that the person who's endorsing it does not have a title to that bill of exchange in good faith accepts it and for as a consideration for something, then he becomes a valid holder in due course. Okay, please take 2 minutes, go through this. Any questions, please ask me. Come on, please take 2 minutes. Any questions you may have, please ask me. Come on, any questions, please ask me. Any questions you may have, please ask me. Please take another minute. Any questions, please ask me. Come on. Any questions? Please ask. Come on. Take 10 more seconds, then we proceed. Okay, so this was the answer. You can go through this answer as well quickly. Because X accepts it in good faith before the bill became due, he can be considered as a holder in due course. Okay, now let's look at the essentials to become a holder in due course. The holder must have a valuable consideration. So please remember, whenever a bill of exchange is endorsed to someone, that someone must have been paid some valuable consideration for some service or goods. To become a holder in due course, a person must obtain a negotiable instrument by paying valuable and lawful consideration for it. That means he should have supplied certain services or goods. When given as a gift or has been inherited, the transferee cannot be a holder in due course. So whenever a negotiable instrument is inherited by someone or transferred to someone as a gift, then the transferee cannot be said to be a holder in due course. He will be the holder of the negotiable instrument. B. The holder must acquire the instrument before the maturity in order to attain status of a holder in due course. So let's say a check is drawn today, its maturity period is 3 months. So before 3 months, before the end of its maturity period, he should come in possession of a negotiable instrument. The holder must have obtained the instrument in good faith. The holder should have no reason to believe that the person who is endorsing it or handing over to it has no good title on the negotiable instrument, and he should accept it in good faith. If in case he accepts it in good faith, then he has a good title on the thing, and he will be known as a holder in due course. The instrument must be complete and regular on the face of it. There should be no defects on that negotiable instrument. It should be complete, signed, and all details, everything should be given. He must have received the instrument as a holder. That is, a holder in due course may either be a payee or a possessor if the instrument is payable to bearer, or the endorsee if the instrument is payable to the order. Okay, so these are a few of the essentials to become a holder in due course. Please take 2 minutes, go through this. Any questions? Please ask me. Come on. Any questions? Please ask me. Please take 2 minutes, carefully go through this. Any questions you may have, please ask me. Come on. Please take another minute. Any questions, please ask me. Let me know once you're done, please. Come on. Take another minute. Go through this carefully. Okay, so let's move on. Now, let's look at the privileges of being a holder in due course. So far we've seen what is a holder in due course. Now, let's have a look at the privileges of being a holder in due course. In case of inchoate instrument, a person signing and delivering to another a stamped but otherwise inchoate instrument. Inchoate instrument is when you execute an unfilled up but duly signed negotiable instrument, so the check or promissory note, it is an inchoate negotiable instrument. That means our blank check, okay, so is debarred from asserting as against the holder in due course that the instrument has not been filled in accordance with the authority given by him. the stamp being sufficient to cover the amount. So in case there's someone issues a check in favor of someone else, but he does not mention the amount and everything, so like he's giving a blank check, and even the name and the amount is not mentioned, but signs it and stamps it for the amount for which the check is issued. Then in that case, whenever it's the holder or the holder in due course, the person drawing the check cannot say that no, it was done against his authority, because he was the one who stamped it and he gave a incoherent instrument. It's quite dangerous to give an incoherent instrument, so please remember never to hand over any blank checks or blank negotiable instruments which are signed to anyone else. So let's take an example. A signs his name on a blank but stamped instrument which he gives to B with an authority to fill up as a note for sum of 3,000 only, but B fills it for 5,000. B then transfers it to C for a consideration for 5,000, who takes it in good faith. Here in this case, C is entitled to recover the full amount of the instrument because he is the holder in due course, where B, being the holder, cannot recover the amount because he filled the amount in excess of his authority. But C got the negotiable instrument in due course and in good faith. So C will be entitled to recover the entire money from B, whereas B cannot recover 5,000 from A because he unauthorizedly filled up 5,000 instead of 3,000. Okay? Yeah. Please take 2 minutes, go through this. Any questions? Please ask me. Come on. Any questions? Please ask. Take 2 minutes, please. So that's one of the privileges of being a holder of an incoherent instrument. Any questions? Please ask. Any questions? Please ask. Come on. Are we done? Okay, let's look at the next privileges. In case of a fictitious bill, in case of a bill of exchange is drawn payable to the drawer's order in a fictitious name and is endorsed by the same hand as the drawer's signature, it is not permissible for the acceptor to allege as against the holder in due course that such name is fictitious. So, if case any negotiable instrument is drawn in a fictitious name and it is also endorsed in the drawer's signature, then the holder in due course will get a good title to it, and the drawer cannot say that it is a fictitious name that is being issued in, and that's why it's invalid. In case of conditional instrument or escrow, in case of a bill or note is negotiated to the holder in due course, the other parties to the bill or note cannot award liability on the ground that the delivery of the instrument was conditional or for the special purposes only. The next one, in case of an instrument obtained by unlawful means or for unlawful consideration, the person liable in a negotiable instrument cannot set up against the holder in due course the defenses that the instrument has been lost or obtained from the former by means of an offence of fraud or for unlawful consideration. Thus, a holder in due course acquires a title. So, in case the holder of a negotiable instrument obtains it by fraud and other things and endorses it or gives it to someone as a holder in due course furtherly, then tomorrow he cannot tell the holder in due course that no, this bill was not, it was lost or it was obtained by means of an offence or fraud, and that's why it's unlawful. Because the holder in due course, if he accepts it in good faith, that is without having knowledge of such fraud or anything, then he gets a good title, defect free from all defects. In the case of original validity of the instrument is denied, no maker of a promissory note and no drawer of a bill of exchange or check and no acceptor of a bill for the honor of the drawer shall, in a suit thereon by a holder in due course, shall be permitted to deny the validity of the instrument as originally made or drawn. In short, the holder in due course get a good title to the bill, because the drawer or the holder cannot say that this bill is invalid. Once it's been endorsed and once the holder in due course gets a good title on it, then he maintains it. Okay, please take 2 minutes, go through this. Any questions, please ask. Any questions, please ask. Come on. Excuse me. Sorry. Excuse me. Come on, let me know if you have any questions. Any questions, please ask. Come on. Let me know what you're done, please. Come on, take another minute, please. Are we done? Come on, any questions, please ask me before we move on to the next one. Come on, okay, and then we go to the fourth one. In case pay's capacity to endorse is denied, no maker of a promissory note and no acceptor of a bill payable to order shall in a suit thereon by a holder in due course be permitted to deny the pay's capacity at the date of the note or bill to endorse the same. In short, the holder in due course gets a good title, as the maker or the holder of the bill cannot question the capacity of the holder in due course, or as on the date of payment. Payment in due course means payment in accordance with the apparent tenor of the instrument in good faith and without negligence to any person in possession thereof, under circumstances which do not afford a reasonable ground for believing that he is not entitled to receive payment of the amount mentioned therein. Okay, please take a minute, go through this, and then we proceed. So with this, we have done with the essential characteristics, privileges of being a holder in due course. Okay, please take a minute. Okay, so in case you're done with this, we will be ending the session with this slide. Okay, thank you so much for being a wonderful audience. Please do not forget to use the code Prathik to get an instant discount of 10% on your Plus subscription. And also an important point is this 10% is being reduced to 5% from 1st March 2021. So this 10% is going to be applicable only till your Plus subscriptions made till February 28, 2021. So if you are thinking about or have decided to make the Plus subscription but have not done so already, this is the time for you to do it. So please go ahead and make your Plus subscription to get an instant discount of 10%. Use my code Prathik, Prathik. Alright, and once again, I would like to welcome you to Crack CA Exams with us, which is a vertical and channel of Unacademy that caters to the students of CA Foundation and Intermediate in their journey and pursuit of preparation for the CA Foundation and Intermediate examination by providing top educators, quality content, and overall a great learning experience. So come, let's crack CA exams with Unacademy, India's largest online learning platform. Alright, please do not forget to subscribe my session on the YouTube channel, and also do not forget to click the follow button on my profile on the Unacademy Learning app. Please do download and register on the Unacademy Learning app so that you can make use of the world of resources that Unacademy has to offer to you. Alright, so thank you so much for being a wonderful audience. It was a pleasure to take this session for you, and I shall be back with some more interesting sessions. Thank you so much. Alright.